Okay, good day, everyone, and welcome back to another of our strategy class training. It's beautiful to have you here. Hope you're having an amazing day and a great week. Okay, so we are going to be basically looking at another segment of our strategy class, so the ANZO strategy series. And today we are going to be discussing divergence. Now, for those of you who are new to trading, you probably need to begin from start from scratch. However, just stay with me. You should be able to get some of the points being discussed. But we're going to be looking at divergence here and what is actually divergence in market and how can we use that as a system. Now, it's very important to note, right, to you guys that there are so many trading strategies and many of them can be profitable, but they will only be profitable for you if you take the time out to harness it and make a system for yourself. So, every single strategy class is almost different, right? We're looking at different systems, different strategies, and you're not going to now be applying every single system because it doesn't work that way. What you want to do is if you learn a new system or you learn a new thing, you want to go and practice it. First of all, you want to see, do you like the idea behind the system? Does it fit your own trading style? Does it fit your trading personality? Please, who is annotating on my screen? Don't do that. Right? Does it fit your trading style? Does it fit your trading personality? And if the answer is yes, then what you want to do is you don't just take it and begin to trade it. You want to back test it, right? You want to back test it long enough to be confident on how you want to trade it. So basically, what you're trying to do is you want to make yourself confident in the system, because it's that confidence that will then lead into profitable trading. Because many people, the problem is they learn a new system. Oh, they're now SMC traders today. Tomorrow they're trading resistance and support. Next tomorrow they're trading something else, and they keep bouncing around, trying to find the holy grail to trading. Whereas the point is not about finding one strategy that always makes you money. It's about harnessing a system, understanding and basically being comfortable with that system for yourself, that you know how to use it to make money for yourself. So every single strategy can make you money. However, I can teach 1,000 things. You need to practice and figure out the one that you prefer the most, and test and test and test and back test. Take many trading journals, and you'll be able to come up with an edge, right, with a trading plan that suits your system. Okay, so enough with the introduction. Very brief, very quick to note. Disclaimer: when it comes to trading, there is always risk. The information taught in this particular training are for educational purposes only. So trading carries a high level of risk. This is very important. You need to understand this. But the point is, just because there's risk in everything, just as there's risk in driving a car, that doesn't stop you from driving. What it's going to do, or what you need to do, is figure out how to drive well, right? In the same way, there's risk in starting a business. There's also risk in trading. You want to figure out how to trade like the best traders do, or how to build an edge for yourself. Okay. So here's what we're going to be covering today. I told you that we're going to be looking at divergence as a topic, right? So we'll look at what divergence is, the different type of divergence. I'll just show you basically, and then we'll see how we can spot them, the kind of indicators needed for this particular system. So for this particular trading strategy, we're going to be needing at least one indicator. Many of you can decide to add multiple, but at least we're going to be needing one indicator. And then we'll see how we can build a system around it. I'll try and help you for what to look for and how to get involved, right? Now, remember, like I always tend to discuss with you guys, when it comes to trading, like when it comes to having a trading system or a trading strategy, there are a number of things that are quite important, right? If we decide to place a buy in a market, right? We decide to buy a trade, we try to place a buy. We are buying because we anticipate price to go up, right? So what it means is we need a reason to establish the buy. We need a reason that says, okay, I want to buy because, right? So maybe it's because we are trend-based traders and we're trying to follow the trend, right? And then that's our reason for wanting to buy. Now, just because you want to buy, right, the market is bullish and you want to buy, doesn't mean you enter the buy at any point, right? So imagine this market is very bullish and you try to buy here. Now, if you buy here and the market continues to go up, well, good for you. But if you buy there and then the market comes down, this might be a very big loss for you. So it's about figuring, okay, where do I want to trade? Where do I want to trade, or what direction am I looking to trade? Is it bullish or bearish? And once you define that, you now ask yourself, how do I get into the position? So the first point will be, why am I looking to buy? Once you've established the reason for buying, or why am I looking to sell, then you ask, how do I enter the position in terms of what are my entry confirmation or my entry criteria? And then you ask yourself, how do I exit the position in case of when I'm wrong, as for stop loss, and when I'm right, for take profits. All of these different factors should be included in your trading plan. How many of us here have trading plan? Type in yes if you have a trading plan. Some of you just open the chart, and when you see the market making, the NFP is coming out very shortly. Some people will just open the chart and see a very big bullish or bearish candle and begin to sell or begin to buy. And there's no reason whatsoever behind it. You should have a trading plan that, that I would even recommend should be documented, should be written out trading plan that says exactly what you look for in trading, why you look for those particular specific criteria. Okay. So for today's class, we're going to be looking at divergence. Now, divergence on its own, when the market is divergent, would not make you money. It's more of a so in the context of what we're discussing, right? In the context of what we're discussing. So the first point, right? Point one. Okay, let me use this. So in the context of what we are discussing, right? Point one would be, where's my whiteboard? Okay, so in the context of what we're just discussing now, the first point here would be how to decide on the direction, the market direction, right? The market direction you want to trade toward. Are you looking to buy? Are you looking to sell? And why? Okay. So if you say, I want to be a buyer in the market, why do you want to be a buyer in the market? Or you say, I want to be a seller in the market, then why do you want to be a seller? How you define that should be the first point on your trading plan. Okay. I think my screen just went off. Okay. You should see my screen. Okay. So the first point would be, so let me just type this out here and make this black. Would be what direction you're trading. Okay, how you define the direction to trade. So this is as pertaining to whether you are bullish or bearish, right? And then the second point would be, so now you've decided, based on this and this and this, I think this market wants to go up, right? So once you've established that, based on certain criteria, you are bullish in the market or you're bearish in the market, the next point you want to ask yourself is, where and how do I enter? And this is where we'll look at your entry criteria, right? And then once you've defined your entry, you want to look at what are my exits. So how do I exit the market? And there are two types of exits. So there's the stop loss, that's when you're wrong, and take profits when you're right. Because you know that you can be right about the market direction, and you enter the trade, the market begins to go your way, and you don't exit the market, or you don't have a method for exiting the market, and all of a sudden the market reverses and your initial profit becomes a huge loss. You were right initially, but you were wrong overall, at least based on the system. So these three criteria should be something you always imbibe in your trading plan. I don't care what type of trader you are, whether you're scalping, you're day trading, you're swing trading. I don't care whether you're trading based on indicators or you're trading based on price action or you're trading SMC. I don't care what you trade. The idea is your trading system should contain all of this. Should contain these three. You should have these three criteria: how you define market direction, how you decide whether you're bullish or bearish in the market, how you enter the market, that's your entry criteria, and then how you exit the market when you're right, and how you exit the market if you're wrong. Okay, so now the reason I'm highlighting this point is that divergence, what we're discussing today, is basically a way of looking for. So it's going to mostly point out at what you call it. So let me get this too. So it's going to be for the first point, right? So with regards to how you decide on market direction, right? Now, once you've decided on the market direction, the next point will be, okay, how do you enter the markets? Now, that is where you can apply several entry conformations. So there are candlestick patterns. There's even the Y curve accumulation and distribution schematics that we looked at the last time. So you can apply that. But with regards to divergence, it's about figuring out if we're looking to buy or sell. I hope that point is clear. Okay. Now let me let's move on to the next slide here. Well, I didn't even introduce myself. I'm sure most of you might know me, some of you might not. Okay, just quickly, my name is Nana Obin Alexander. I'm the head market analyst here at ANZO. So let's just skip that and move on to the next slide. Okay. Now, what is divergence? Well, in forex markets, where divergence refers to the point or a case in point where the price of an asset is moving in one direction, and then we have a technical indicator such as an oscillator moving in a different direction, right? So imagine that. So the idea is this: you're looking at price, and price is making higher highs and higher lows, right? So see, this is a bullish market, right? Now, as price is making these higher highs and higher lows, if you have an oscillator or some sort of indicator that basically moves with price and oscillates with price, let's say somewhere like down here, let's say something like RSI or stochastic. When price is making higher highs, you'd see that the oscillator would also be making higher highs, at least with the immediate structure, right? With the immediate lows. As price is making lower, basically lower, higher lows, you want to see the oscillator make higher lows, right? Now, this could come down like this. It doesn't matter. But the point is, for example, this point here, where price is making higher lows here, the oscillator is also showing higher lows here. The same point, price is making higher lows here, the oscillator is showing higher lows here, price is making higher lows here. Now, but in a case like this, where we have, so let me just draw this again. So we have this, everything is going fine, right? Everything is going fine. And then we have the oscillator make a, right? Make a different movement in the opposite direction of price. So I know this it doesn't look very fine. That way I'll show you examples of that in the market. That is what we call divergence. So it's when the price of an asset is moving in one direction and an oscillator indicator is moving in the opposite direction. Now, there are different types of divergence in the market. The one we would mostly be looking at is mostly just the regular divergence, okay? And so the regular divergence is the one we'll be looking at. Now, the idea is this, right? In this particular example here, the blue line is representing price, and then the red one is representing the oscillator. So you can see that in a regular divergence, price is making higher highs, right? The oscillator is making lower highs. Now, this is a bearish sign. So we're saying that the market is bullish, price is bullish like this, making higher highs. However, the oscillator is making lower highs. And then the bullish one would be that when price is making lower lows, and then the oscillator is making higher lows. Now, remember, there's a very important point I want you to keep in mind here is divergence in itself, does not really make sense. You have to put context into it. So one area where divergence is very, very powerful is in a market that has been overstretched. So if a market has been bearish for a long time or bullish for a long time, and then you spot divergence, it is more potent than a market that is not really bearish or not really bullish and you're seeing divergence. I don't know if that point makes sense. So when the market is divergent, the context of the market is very important as to regard whether that divergence is something we want to consider trading or not, or something we want to consider as a directional bias or not. So if a market has, for instance, been very, very bearish, right? So like GU or EU has been very, 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 very bearish for a long time, right? At least when you look at it from that specific time frame, right? Now, also, you know, these things can be applied on every single time frame. My advice would be, if you're looking to trade divergence, don't go below the 4 hour. So anything from daily, the 4 hour, so from the 4 hour, the daily, the weekly, the monthly, at least between the 4 hour and the daily time frame, maybe the weekly, and you spot divergence, it's potential trade opportunity. Okay. Now, if you find a market that has been this bearish, just like EU or GU has been, what you expect is for the oscillator, right, to be making lower lows. However, if at this point where price has made a lower low, we now find our oscillator making a higher low. You can see that there's a discrepancy between price, between what market is doing and what the oscillator is doing. So price is making a lower low. However, the oscillator is posting a higher low. Now, this here is what we call divergence. Right? Now, what does this tell us? Does it say, what is it telling us? And start buying, start buying, start buying? No, the answer is no. It's telling us that what we're at least the way I look at it would be that, well, there is a potential that this market wants to pull up, wants to, wants to move in the opposite direction. Now, moving in the opposite direction might be it just moves up a little bit to continue going down, but that move up could give us opportunity to buy. Or it could be that it's a situation where the market is now changing direction and want to go in the opposite side, okay? So divergence is basically most applicable when we're looking at the market that is being stretched, that's been overstretched in one direction. And if we spot divergence, then we can begin to potentially look for confirmation to trade. This is the one time where you can look to trade against the trend, okay? Now, don't worry, we'll look at examples. I know it gets a little bit confusing, but just quickly type in a yes. Let me know if you're following. If you're understanding so far, what we're discussing, if it's making sense, just type in a yes to let me know that you are following, and let me know that it's making sense. Okay. quickly. Okay, now while you're typing that in, now what do you need to trade divergence? What do you need? Well, like I mentioned, with regards to this particular system, you only need at least one indicator. Some people might decide to combine a number of them. However, you don't need much of them. What you need is price movements and then one of these oscillator indicators. Okay, so there are a number of oscillator indicators, but here are the 4 popular ones. So there's the RSI indicator, there's the stochastic indicator, there's the MACD indicator, and then there's the momentum oscillator. Now, there's no over complication with regards to how you use them. It's just to attach them to your charts and see how price is relating with them. Okay, so if you don't worry, I'll show you what that looks like in a bit. So what you want to do is stick to one, right? Especially if you are new, or if you've not really done something like this before, or you've not traded this system. What you want to do is just pick one and stick to it. Most times people prefer to use the RSI or the stochastic. Any of them is good. If I was to choose, it's either going to be between the RSI or the stochastic. MACD can be a little bit confusing for new traders because of the way it looks. And then momentum oscillator is not always available to every particular trader. I don't think it's always available on every system. So the RSI or the stochastic is enough. And the good thing is you have both the RSI and the stochastic on your mobile MT4, right? So you can see it on your MT4 on your mobile device. I think you can see MACD as well. Okay, so that's the good thing about the divergence indicators. Okay, so any of them on any of your devices, you can apply this. Okay, so now what we'll do is we would go over and look at some examples of divergence and how we can potentially trade them. Now, remember, like I mentioned, the idea is we're looking at divergence to spot potential market direction. Once we've spotted the direction, once we've identified the direction we want to trade towards, once we've identified divergence and we say, okay, this market is bullish divergence here, that means if somebody says the market is Euro USD or GBP USD is showing bullish divergence, it means that the market overall has been bearish. But then there's a discrepancy between price and oscillator that is pointing that price may begin to go up. Now, the going up that price might be a temporary, retracement, or be, a very large pullback. However, whether it's a small move or a large move, we can now apply our entry confirmation to look for those opportunities to buy or to sell. Okay. Yeah. Okay. So those of you who are saying you don't understand, I'm guessing that you're really, really new to trading. And just like I mentioned in the onset, you want to take advantage of the course, the free trading comprehensive course from ANZO Capital, courtesy of me, that you can take advantage of. But for those of you who are traders, I'm sure this is one of the simplest systems that there's no complication. You just look at price, look at oscillator, and we're good to go. So, but I think examples would do us justice. So let's jump over to our charts and look at this. Okay. Now, for most of you, you'll be using, you're on your MC4. The same concept is applicable. Whether you're in the MC4, you're using TradingView, or you can apply the same concept. On the MT4, just go to indicator, and then just go to insert. Like if you're on your MT4 on your laptop or your PC, you go to insert, go to indicator, then go to oscillators, and then you see either the RSI, stochastic, momentum oscillator, MACD. If you're on your mobile phone, you just tap on the chart, on the indicator, and add the RSI or the stochastic. And then if you're using TradingView like I am, you can obviously just add indicator from this indicator panel here, okay? So what we're going to be using today, basically, is going to be the stochastic oscillator. It doesn't really matter. I can use the RSI or the stochastic. It doesn't really matter, okay? Now, when you look at this market, right? So we're looking at this market. You're looking at GBP USD. So let me draw here. You're seeing that the market is, let me change this color, okay? Clearly, we're seeing that the market is bearish, right? So the market was bullish, right? So we had a bullish market that then shifted bearish and has been bearish ever since, making lower lows and lower highs. And so this is a bearish market. The market has been, now in terms of overextended, you can see that the market has been very overextended, right? It has basically been falling for how long is this? Let me see. This is since July 14th. Price has been on a very strong bearish market, and now we are in October. So from July to October, this market has been falling, right? If we look at the 4-hour chart, let's see, it's also very bearish, right? So if we look at the 4-hour time frame here, we're looking at the market that has just been falling and falling and falling, okay? Now, if we add any of our oscillator indicators, so the RSI or the MACD or the stochastic oscillator, the one I have here now is stochastic oscillator. Remember I said any of them would show you the same thing, they'll just show it in a different way, right? Now let's go back to the daily time frame. So we're looking at this, right? Now, if I add, so down here, how to add this on trading, you just click on indicator and search for oscillator. Okay, so you can see the name here. Let me see if I can bring that up for you. I don't know if you guys can see my screen very well. Can you guys, let me adjust this up a little bit. Okay. Everybody can see my screen clearly, right? Okay, thanks, Patrick. Okay, so we are clear with one thing. This market has been bearish, right? So you can see price making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower low, lower high, lower low, lower high, lower low, lower high, basically lower high, lower low. So this is where we are now, right? So we're pushing up. Now, but notice here, notice one thing. So if I just take this, so we look at this point, right? So we see this low, this particular low here. If you track price down, that's the low here, right? I hope you guys are following. So this is the low here, and this is the low here. Again, this low here is this one here. You can see there's what they call it. What do I call it now? There's both price and the oscillator, they are both moving. They are showing the same thing, right? So price is making lower lows and lower highs. Again, so we have this low, right? and then this low, and you can see this is the low, and this is the low. So it's lower low, lower high. Again, you have this low, and you can see price making lower lows and lower lows, right? So lower lows on both ends. So if you come down to this most recent low, right? The good thing about this system, the good thing about me talking about this is that it's happening live. So this is live markets, okay? So you can see we have this low here. And then let me zoom in a little bit. Okay, so you can see here that we have this low here. And then we have this low. This low, this last low, is definitely lower than the previous one, is it not? It is, right? However, look at what our oscillator is showing us. Look at the previous low, that's this one. And then look at the recent low, that's this one. So you can see that in this case, if I were to draw a trend line, so let me draw a trend line. Let me use the trend line instead to connect the lows. So if I were to use a trend line to connect the lows, it will look something like this, right? This is the low. However, if I connect that same low on the oscillator, you can see that this in the actual price, it is making a lower low. But for the oscillator, it's making a higher low. You can see it down here. Okay, so let me bring my trend line. You can see it here, it's making a higher low. So there is a discrepancy between price and oscillator. So the market is showing us lower low. However, the oscillator is showing us higher low. And that's what is called divergence. Now, what does this mean for us? Well, remember, like I said, just because we spot divergence, it doesn't mean that we start buying or start selling. It's not an entry confirmation. It helps us identify the first point, which is what direction is price possibly going to go. Remember that we could be wrong and we could also be right. That is why I'm using the word possibly. So we're looking for reasons or clues in the price to tell us what direction the market wants to go next. There's a reason why, well, personally for me, I've been very bearish on GU. I've been very, very bearish on GU. Basically, ever since we had this low here, and I've been looking for sales, and it's been delivering beautifully. Now, I stopped looking for sell just around here, and this was one of the reasons. Now, I don't trade divergence in itself, but this was one reason why I started looking at, well, potentially we could see the market begin to go up, and you could see that we're having this push up now. Now, whether the market push up and now begins to go up is one point, or whether the market just push up to maybe make a slight retracement to continue to go down, that's a different point entirely. However, just by identifying that the market was divergent here, we would have been able to look for buy opportunity to take advantage of this move upward. I hope everybody is following so far. So we use divergence to identify potential direction in which the market might move, right? And once we identify that direction, we will now want to drop down to a smaller time frame to look for entry confirmation. Does that make sense? Okay. So now we've identified that on the daily time frame, what price is doing here does not correlate with the oscillator. So price is showing lower lows. Our stochastic oscillator here is showing higher lows. So the market is divergent here. Now, so what we want to do, or what you might look to do is, so you can have a trading plan where if you spot divergent on a daily time frame, you now go down to a 1 hour time frame to look for confirmation, right? Your confirmation can be something like Wyckoff accumulation schematic in this case. It could also be candlestick formation or counter trend line break. Okay. So now what we'll do is we'll go down to the we've seen that we're divergent on the daily. So we'll go down to the 1 hour chart, right? Now remember, on the 1 hour chart, the indicator will be showing something else. We're not interested in the 1 hour divergence, right? You can also have it as a trading plan where you're like, okay, if I see divergence on the daily, I'll go down to the 1 hour and see if I can find divergence. So in this case, we had a bullish divergence on the daily. And then you can see if I go down to the 1 hour chart, maybe I find 1 hour divergence. Now that might not always happen, but that could be something that you do. Somebody says they can't see my screen. Please, other people confirm if you can see my screen, please. Can you guys see my screen? Okay. Yeah, people can. Balogun, please check your device because everybody else seems to be able to see my screen. Okay. Yeah, everybody seems to be able to see my screen. Okay. Okay. So remember, so this is the area where divergence. So like I mentioned, we've seen divergence on the daily charts. We've seen that we're showing bullish divergence. That means the market will want to potentially go up. Now, one thing you can do is you drop down from the daily to the 1 hour and then look for, you can say on the 1 hour, I want to also see divergence. That could be that if you spot divergence on the 1 hour time frame, that could now be further confirmation. So in this particular case, this was the daily low that formed the divergence. Now, if we drop down to the 1 hour chart, so this is the 1 hour chart now, you'd see that here, right? At this point here, price is making a lower low. So from this low, right, so you can see this is a low and price made a new low here, right? If you track the movement here from here to here, that's, let's see. I'm trying to see if there is a, okay, look at it here. So price made a low, made a lower low. However, the oscillator showed a higher low, right? So now there is confluence of divergence. So on the daily, we're divergent, we're bullish, we're showing bullish divergence. On the 1 hour, we are showing bullish divergence as well. And what do you see happen afterward? Price began to move up. Now, this would not always be the case. You might not spot divergence on a lower time frame, but we're coming down to a lower time frame to be able to watch for confirmation. Now, confirmation can be anything you're already comfortable with. It can be candlestick formations, it can be price action setups, it can be trend line or counter trend line break, right? That could be your confirmation as to how you enter the trade. We've decided on the direction we want to trade, which is buying, but how you enter the trade is now left to your confirmation. Another confluence of that is we spotted another bullish divergence in the markets as well. And notice what price did. Well, price made a low, made a lower low. Oscillator made a low, made a higher low. And notice that price never came back to that area. Now, even this was the only candle here. So if I draw a line like so, if I draw a line from this low, where is here? So if I draw a line from this low, you see the market never closed below that area. Now, this might not always be the case, but you can see that from this area that we were divergent, notice how price began to move. Now, this move here, is already what, 160 pips, right? So we have about 160 pips. That's a lot of money in the markets, right? If you're trading a standard lot, that's like 1,600. If you're trading a mini lot, that's like $160. Trading a micro lot, that's about $16. So it doesn't matter what somebody, I think somebody asked, how do you trade this on $100? You can trade anything on $100. You can also trade anything on $1,000. It's all down to your risk and your lot size, the lot size you use. Okay. Now, another confirmation you could also look at is candlestick setup, right? You could look to say, oh, I'm going to look for bullish candlestick setups that I can trade. Now, this is should already be something that you have an entry confirmation. The problem is most people don't know why they get into trade. They're looking at the market on the 1 hour time frame and they see the price going up. What they don't understand is on a daily time frame, this market is very bearish. And they are looking at the 1 hour time frame as though that's the end all be all, right? So you should have rules as to how you get into trades and why you get into those trades, and then how you exit those trades. Okay. So in this particular case, there's also Wyckoff accumulation schematics here. I talked to you guys in one of the last strategy class. We looked at Wyckoff methodology, and you can see here that we had basically a Wyckoff schematic here. We had you can see this is our preliminary support, our selling climax, automatic rally, our ST, sign of strength in phase B. This would be our spring, and then price breakup. So maybe at the point where you see this move, right, if you're watching for Wyckoff accumulation schematic, and then we show our sign of strength with this break out of that range here, that could be your reason for buying. And then, you could now start looking for buys along the way. Otherwise, some of you might use something like candlestick formation or counter trend line break. So counter trend line break in this case would be, you might, somebody might say, okay, well, the market is divergent, right? And I would maybe look for, let me see. I'll look to trade the breakout of the trend line. So I can see this trend line here. Let me just draw that. Okay, so somebody will be like, okay, I can see this trend line here. And if the market breaks out of that trend line, I'll look to buy on the other side. I can see we had the breakout and then we begin. So how you confirm is different. Within this area, everybody sees that the market is divergent, but how you confirm is entirely down to you and the system that you've backtested and you're comfortable with. And this is where practice and journaling comes into play. Some other person who sees the market's divergence here, based on the way they trade and how they confirm their entry, this move here, this one aligns with that. But maybe something like this, you see that the market is divergent here, like so, right? You see that we are divergent again on the 1 hour charts. And the moment we showed this, and we pull back into here, you start buying, okay? And then you hold on to your trade. So maybe you have a situation where you see some, you're looking to do something like this, where you are, let's see, not there. So somebody else might, after seeing multiple divergence here, might look to go after something like this, maybe 1:4, 1:5 RR, based on their entry criteria. Now, you might get stopped out here. That's fine. Some other person might wait for the break of the trend line. And then when we had this break here, begin to look for buys. So you can have this as your trade where okay. After we had the break of the trend line, you can protect yourself just under the low and go after 1:2 or 1:5 or whatever, or however it is you look to exit your trade. But notice that we are now looking for buys in this market as opposed to sells, because we've identified the direction we want to trade toward. Now, this doesn't mean that, because we're divergent, we must now begin to go up forever. It might just be a situation where the market gives us a sign that the market is overstretched for it to pull back and then continue going downwards for us to be able to take advantage of this move up. And then we might even look for a move down. Now, you can find a situation where, on a 4-hour time frame, you now see the market showing bearish divergence, and then you maybe use that to sell. But we're identifying the direction we want to trade towards, and then we're looking for our entry confirmation as a reason to get involved in the trade. I hope everybody is following. What I'll do now is let me see if we can spot another example of divergence that we might look to trade. So let me go to, let's say, Euro USD. Let's see if we're divergent on the daily, similar thing. So we're having the same type of, so let me just clear all of this. This is old analysis. Okay, so we're having the same type of situation here. Notice that we are showing lower lows, right? However, see price oscillator making higher lows. Price is divergent on the Euro USD. It's bullish. It's showing bullish divergent on Euro USD. It's showing bullish divergent on GBP USD. So chances are, well, we might see price go up. Now, it might go up because this is now, we're not on a weekly time frame, we're probably in a bearish market, right? We might see price move up. So then maybe either continue going up or price might move up to then break down. However, that move up there could be a lot of potential trades on our end if we know where to look for. So somebody says, why not we use different charts entirely, EU and HAT? Okay, no, so it's about spotting divergence. That's you could spot divergence on anything. It's just a situation of, so what do I use now? Give me a chart give me a chart. Type in a chart, a pair you want us to look at, okay? But divergence is not going to happen everywhere, right? Let me see if I can find an example here, just similar, right? If you're expecting to see divergence every single day, then you're sitting on a long thing. Say gold. Well, gold and GU and all of them, they all move similar too now. XAU, X. Okay, yeah, XAU, USD. Okay. Let me hide all of this. Okay. So this is daily time frame. We're not divergent. We're not divergent on the daily time frame on gold. Let me see if I can spot an area where we were. Okay, look at this, right? So look at this here. Let me use this vertical line. Okay, so let's see. Look at this, right? No. Let me use a different gold chart. Okay, so this is XAU USD, right? Now remember, when we're looking for divergence in the markets, we want to see a stretch market. So it's not, let's say the market is moving like this. If the market is doing this and I see divergence, doesn't mean, I'm not going to be interested in looking for, if price is divergent like this. I'm not going to be interested in looking to trade that divergence. What I want to see is a market that is bullish, right? And then I see divergence, or a market that is bearish, that is clearly bearish, and then I see divergence. So the context of the market is important. So you see how, we've been bullish, right? And then even within this range, we've been very bullish, right? Now, notice this, right? There's divergence here. You can see it. There's even bearish divergence, and then there's bullish divergence. This is a good example. Okay, so let me zoom in a little bit. So now notice what you're seeing here. Well, bearish. And daily time frame, this is a lot of move. Price has been making lower lows, lower highs, lower lows, lower highs, right? And then price made a okay, no, this does not meet the criteria. We're making higher lows on both sides. That doesn't fit the bill. Let me see. There's no divergence here, but there's one here that I just noticed. Okay, so that you can see price is making higher lows, right? And then notice our oscillator making lower lows. Can you see that? Okay, so we're making, you're seeing clearly here that price made a higher high. Sorry, I mean higher high, not higher lows. So price made a higher high, and our oscillator here made what? A lower high. Do you understand? What happened afterward? Well, price began to fall. Let's see how far it went. And you can see we had this fall off here. So let me clear all of this, right? So we had a divergence market here where price was doing one thing, making higher high. However, our oscillator within that same area, you can see this is the same area, right? This is the high. Where is here? This is the high, right? To this other high here. And you can see that in this particular case, we're making a lower high, right? So the market was showing us divergent at this point. So at this point, when we see this, so let's say you're looking at the markets and you've been buying. So you've been a buyer in the market because the market was bullish. At the point where you see this means that, at least the way I would look at it is, doesn't necessarily mean I'll start selling. It means I would not be aggressively looking for buying as I was looking for it before. Instead, if I find good selling opportunity that meets my own entry criteria, I'll be willing to take those trades. And when market confirms that selling, which we had when we broke below the structure here, I'll be aggressively looking to sell the market. Okay. So you can see the same example, different, the same, almost a similar situation. This is the bearish one, which is also good because the example we're looking at on EU and GU was showing bullish divergence, and this one is showing bearish divergence. And you can see, so what we can do now is go within here, go down to a 1 hour time frame, look for confirmation to buy. So it could be something like, so let's see if we can go back there. So let's go down to the 1 hour. Let's see if we can find that area. Where is this? Can't remember what dates is that. Let me go back to the daily just to find that dates. So this was April 26th, around April 28th. Okay, so let's go down to the 1 hour time frame. We're looking for April, so this is August. Let me clear all of this. No, let me clear all of this. Let's delete those. So let's go and find that area. Okay, that's it here. So we have, so you can see that obviously the structure on the daily and the week and the 1 hour are different, but we understand what we're looking at on the daily time frame. So this is where we're divergent. This was around April 28th, thereabouts. April, yeah, that's it. Okay, so now I come in here and then somebody might say, well, I'm going to look for counter trend line breaks, right? So let's say something like this, because obviously you will not be selling this high because the market was still bullish at this point. That's not shown divergent. But then when you spot divergent, the market might be somewhere around here. And then you want to maybe confirm. So you might say, oh, if we have a counter trend line break, I'll look to trade that. Some other person might say, oh, I want to see some break of structure, right? So you can now begin to look for break of structure to the downside. So somebody else might be like, okay, if we begin to break structure to the downside, I'll be okay looking for buys. So we broke structure here. We came back to previous SND. If you're looking to trade SND, you can see we came back to previous SND and then we began selling off. Okay, so we use the divergence to identify potential movements, direction we want to trade towards, and then you can see what happened. The market just began to fall off, and then that's how we shifted from very bullish market to this very bearish market, right? And on. Now, this same concept can be applied on even smaller time frame, even though I wouldn't suggest it because you see it occur frequently. So let's say on the 1 hour chart, we might be divergent. You can go down to a 1 minute chart and look for confirmation. So entirely up to you. Or a 5 minute chart and look for confirmation. The concept itself is the concept itself is well grounded. Your application of it is basically what will make you money or loses you money. Okay. Some of this is, can I zoom in my screen? I have zoomed in my screen. I do zoom in my screen. Yeah. So the person who asked that question initially, I hope you have that clarity. Who was that? I think it was Valion or something like that. You wanted me to use a different instrument to show an example of this. Okay. Let me even see if I can spot more divergence here. And let me see if I can spot the ones that fail. Because remember, it will not always it won't always, just like every single strategy, it will not always work in the sense that, and sometimes it will not work the way you think it will. So we might be divergent, price is showing lower lows, oscillator is showing higher lows, and then the market might still go down a little bit before beginning to go up. It's, we might be divergent multiple times before we begin to present the movement that the price wants to go toward. Yeah. Okay. Yeah. Thank you. You're welcome. You're welcome, Valion. So let's see if we can spot another example. I think we still have, remember now it's time to type in your questions. Drop in your questions. And let's see a similar example here. So this is the daily charts. Yeah, so you can see here, this is daily charts. This price action here. So we have this low. They are equal low. So this is not the regular divergence. It is divergent, but it's hidden divergence. And that's not what I'm teaching you today. But it's divergence here, but I'm not going to discuss that. But you can see, well, in this case, we made equal low, right? Like this. However, price is making higher low. Like so. Yeah, you can see it. Making higher low. That's also divergence. This hidden divergence. Let's see. And then, so look at this. Yeah, this is also a good example. Price is making slightly higher, equal low, almost lower low set, right? But then the oscillator is showing higher low. Now the market is divergent here. But notice that, somebody else might be like, oh, I'm going to buy. So let me zoom in a little bit. Hope you guys can see this, right? Somebody might say, oh, look, you can see we made low and we made a slightly lower low. But however, oscillator is showing a higher low, and then I'm going to buy, right? Now, if you use something like a counter trend line break on the smaller time frame, your counter trend line might look something like this. You might have a counter trend line inside here that gets broken here, and then you get involved in a trade. And you can see price came back down again to clear that movement before beginning to go up. So the divergence itself wasn't wrong. Your entry criteria, not your entry criteria too wasn't wrong, right? It's just like with everything in the market, I don't win all my trades. Many times I'm right about direction, but because the market does not give me an entry based on my criteria, I don't get involved in the trade. It doesn't mean that I'll now discard the way I trade. No, I understand that is my edge, right? And I know how to play the game. So Valiant said, do you use the wick or the close of the candles when looking for divergence? We're looking at the low, so the wick is important. So we pay attention to the wick as well. You can decide to now. There's no, so this is where your like I always say, your back testing comes in. So you take what you learn. You don't say, oh, Mr. Obina, this taught me this, or the FX JEDI, which is what I'm called. You can go on, search me off on socials as FX JEDI. However, you're like, oh, this is what it's taught. No, you don't take anything at face value. You take it and you go and test it for yourself. And sometimes somebody teach something and you test it and you don't like it, or the result that gives you doesn't make sense. Then it doesn't suit your own style. But what you do is you go, okay, I'm going to try and spot divergence and see how I can trade it. And then once you've taken enough demo trades or testing or done enough back test on it on the system, you have confidence as to exactly how you look to trade it and why. Right, so you can decide on your own that, okay, based on my own system, I don't incorporate the wicks. I only look at the close of the candle. And somebody else might look at, well, I only incorporate the close of the candles or the wick. The wicks are also important as well. So let's see, can I spot divergence? Let's see. No. I'm looking for a market that has been stretched. Let's see, nothing. Yeah, you can see similar situation here, although you can see similar thing here as well. The market has been bearish. We came to this low, pull back, made another low, okay? So we made kind of you can see that this low here is actually lower than this low, slightly. So we're making a very slightly lower low. But see what the oscillator did, made a higher low. And what happened? Well, price pushed up. Now, eventually began to come down, but this was a lot of movement already for us to be able to capitalize on. Okay. Push. Let's see. Look for stretched markets. Yeah, same thing here. Yeah, look at this. We had this parabolic market where the market just basically went up in almost like a straight line. We had this high, so you can see our oscillator made a high here, right? And then we had another high here. But see how we made a higher high on price, but we made what? A lower high on the oscillator. And what happened after that? Well, price fell off. And you could have been able to capitalize on that. Yeah, I can go on and on and on and show you the same thing on every single pair, on every single currency, on every single time frame. It won't always work, but at least this gives you an idea as to, so this is the reason why I might look at the markets that have been very bullish and it's still showing bullishness. And I might be like, well, I want to stay away from this market for now until I find clarity, or be like, those of you who know me know that I always trade in the direction of the trend. But there are times where, the market is very bullish and I'm either not doing anything or I'm actually looking to sell. But most people, they're always doing the opposite. They're always trading against the trend. And, the market is bullish and they're trying to sell. They're trying to sell every high and they end up becoming liquidity for people like us who have been, trading in the right direction. So that is on one hand. Remember, this class is just one of, right? To get full access to some very key, interesting trainings and all, make sure that you not just have an account with ANZO Capital, fund your accounts, and then reach out to your account managers to get added to both the Telegram channel and also the courses, the Google courses for traders, for advanced traders, and all, and that will help you. So yeah, I think that's about it. Our time will be able to take for today. I'll just quickly take your questions, and that will be about it for our session for today. I hope you guys quickly let me know down below in the chat box if you enjoyed the class. And yeah, it's always wonderful to talk to you guys here. Okay. So I'm just going to, yeah.